Welcome everybody to the webinar book talk by Amy Domini on thoughts on people, planet, and profit. I think it's a terrific book. I really enjoyed reading it. And I think we're very fortunate to have Amy join us. So let me launch into it and go through some questions, and hopefully many of you will have questions for her, and we'll try and make sure we have time to cover those. Okay. So to start, as a pioneer of ESG and impacting investing, can you share a bit about what it was like at the beginning and the challenges of founding a social investment firm?
Okay, and thanks for having me, and thanks to all of the audience for your interest in this topic. I did work on this project over the course of roughly 10 years. I was writing articles for a particular magazine, and this thing was put together because I am first and foremost an advocate of my field. I am a person that believes that this is urgently important, that we integrate environmental and social criteria into the investment decision-making process. And I'll go through some of why on that, but that has moved my entire founder journey and continues to move me into doing things that might open one more door or convince one more individual that this is more than just an exercise in feeling good. So many years ago, I guess in the late 1970s, I found myself with my first real job. It was a job that doesn't particularly exist anymore. It was called stockbroker, and you used to help people pick stocks that they wanted to own. And the way you did that at most firms was that your firm did a whole lot of research, and every morning somebody from New York City would come on a loudspeaker and tell you the merits of a certain company. And if you liked the merits of that company, you would call people you had gotten to know and say, you know, here's a stock that looks like it's going up, and I want to tell you about it. And I found myself getting pushback for the oddest reasons. People would say, don't they make weapons? Or, you know, Dad died of lung disease or things. And I suddenly thought to myself, whoa, you know, hard enough to get somebody to take the phone call without making them annoyed. You know, I need to get better at understanding this. So you have a process as a professional, and that's an intake, and you make sure that they can take the risk, and you ask certain questions. So I added to my process, my intake process, is there a kind of investment that you draw a moral line against making money from, or things? And I had a whole lot of, yeah, this or that. Got me started on a whole line of thinking, which I could spend the better part of the next half hour describing, but at the end of the journey, by 1984, I had written a book called Ethical Investing, and that was written because there was nothing written about the topic. And I felt that there was a there, and yet it seemed largely unrecognized. It was a period during which American corporations doing business in South Africa were increasingly under pressure. Excuse me for that phone, I will turn it off. And the strong feelings about the role of corporate behavior in South Africa were a real motivator for me to get it right on writing that book. It did lead to 1986, for people on the call that don't know, 1971 was the first kind of public challenge to South Africa. And that was when the Episcopal Church sent their presiding bishop to General Motors' annual meeting and asked the company to leave South Africa for moral reasons. By 1984, there was a boycott movement in place that was widely covered. And in 1986, that boycott had led to the big crescendo of divestment of American corporations doing business in that country. Every endowment wanted somebody to come talk to their board about should they divest. And I had just written the book and nobody else had. So I became the voice of why to divest for a couple of years there, which led me to feeling extremely passionately that investors have a voice in what happens to people and the planet, and that they need to use that voice, because without it, the standard arguments that I was getting from those boards of directors would prevail. And those standard arguments were, I think investing's neutral. I think, you want to make money and then you go out and you give it away or do whatever you feel like it. That's something, but money is neutral. Money isn't neutral. Money creates incentives to do bad things. And in South Africa, those incentives were playing out very obviously. A lot of data had been collected over that 15-year lead up to divestment. And it was a very obvious paper trail. And so my passion for the field was formed in that era. Everything else that followed, every business, there were 3 businesses that I created, and I guess this is book 6 that has my name on the jacket, one way or another. And everything followed from that passion. So when you say in your setup, what are some of the challenges? There were initially some core challenges, and they still exist. I'm going to be talking to a different group day after tomorrow, and in my prep talk for that, 2 of these challenges were thrown at me in the prep talk. So even
Right.
and after all these years, they're still there. 1, you're going to lose money. And 2, because you're going to lose money, it's illegal. And 3, money is, investing is neutral. There are other things to do if you want to change the world that are more effective. And 4, it never made any difference anyway. And these essentially are the same challenges, but I've made it my life's work to remove them. So the first way to remove them was to create a company that dealt with the challenge of you're going to lose money by collecting an index of our own. And for 15 years or so, there was something called the Domini 400 Social Index, which now is owned by Miskey and is the Miskey ESG. And I have nothing to do with it. I have nothing for quite a while now. But during the years of the Domini 400 Social Index, it outperformed the Standard & Poor's. It outperformed it in a statistically significant way. It was a very interesting study. The index outperformance was about 51, 52% of the time. It wasn't 75% of the months it was better. But the outperformance was more of an outperformance and the underperformance was less of an underperformance. So this blew open the field. It led to my thinking, well, I can fund this kind of research through creating products that people buy, and the profits from those products can continue to do this kind of interesting research. And that launched the mutual fund company. And so our research company had as its purpose, as its mission, to remove the barriers to what we're today calling ESG investing. At the time, we were using the phrase socially responsible investing, and to generate a passion for the field at the grassroots level. And I think I'll pause there, but to say having a passion for the field that you are launching a business in is a pretty good precursor to sticking with it through the years.
Amy, just to follow on something you said, currently, do you believe that an ESG approach to investing improves risk-adjusted return? So even if you didn't want, even if you weren't justifying this or you weren't pursuing this for moral or values reasons, just on a pure economic basis, would you say that your approach provides a better, you kind of implied it done for a while, but even in where we are currently, do you believe it does?
Yeah, well, there have been, over 1,000 studies on that issue, and maybe 2 of them have argued it hasn't. I think it's very important to understand what happens when you do research that brings in these newer standards for evaluation. If you're looking at a company A and a company B in a similar industry, and you think there's some reason why that industry might be attractive over the next few months, you're trying to find your best play in that industry, and you do some homework and you discover that company A has had 2 product safety recalls lately, and has made headlines in how poorly they disposed of their waste materials, leading to state fines of significance, and that company B has not done those things, you already have in 2 data points established one has a more on the ball management team than the other. And we have about 60 data points. So maybe there's not going to be that data point, but there's going to be some data point. I think at the end of the day is guiding the investment portfolio toward a higher quality management team with more of a capacity to meet with the modern world and its challenges. So yes, now I'm kind of jumping ahead here, but the question you ask is, I believe, the reason that we're on the cusp of something pretty darn interesting. And that is, we started with 1929 with Benjamin Graham and security analysis. And we all learned about looking at the numbers when you're picking a stock. And then we got to 50 years later, we discovered modern portfolio theory and, the Yale approach to endowment, and you were going to diversify across all the asset classes because anything that limited your return limited your risk, your universe limited your returns, and kind of caused a revolution in money management. Until that point, you wanted to own 20 good companies. After that point, you wanted to own 45 mutual funds that were excellent in their niche, or maybe venture capital, or maybe, it really was a revolution in the way assets were managed. But each one of those mutual funds, each one of those investments at their heart had security analysis baked into it. Right. It was a building. I think we're now at a 3rd big wave in financial asset management, which, the ESG is a pretty common nomenclature too, but, sustainability investing and impact investing are pretty well known. In my book, People, Planet, and Profit is a run on the more common in Europe, triple P, bottom line investing, people, planet, profit. And that, I think the reason it's got legs and it's going to stay is it's adding a value at the bottom of that whole big thing to the selection process. And as long as it adds value, in addition to being popular with the customer, you have been able to drag in, the big hedge funds, the largest asset managers, and everybody's always interested. Why is it suddenly exploding? Why does Morgan Stanley, why do they all have an ESG score on the front page of every report they put out? That's going on because they're getting value out of it. They wouldn't do it if they weren't getting value out of it.
But Amy, do you think that security analysts, both on the sell side the buy side as well as the sell side, do you think that they need to start analyzing companies differently? And are you seeing that they're beginning to?
Oh yes. I mean, sell side research now, I mean, your Bloomberg machine or your FactSet machine or whatever you use to get your raw data from, provides you with a good deal of ESG research, and in many cases a rating service, an actual one number score, which I think is too simplistic, but it does provide it. Both sides of that equation, sell side or buy side, Wall Street or the investment management side, have the same issue, that they don't get to keep the customer unless they're right more than they're wrong. Right. So their incentives are pretty clear. That's the only reason they do something. Or, yes, there's always an interest in being more appealing to broader customer base and all that, but they wouldn't follow the same rules I follow if it weren't
right
getting them the results they want. Then reframe the whole question to work for their way of thinking.
But as you see research coming out of both, again, on the buy side or sell side, and you look at it, say, now versus the way it was 3 to 5 years ago, are you seeing that the ESG aspect of companies' risks and opportunities is just more front and center than it was?
Oh, yes. I'm in the fortunate position of being on the buy side. So, there are 4 or 5 favored firms, sell side research firms that I work with most often. And every one of them has an ESG analyst report every day on a new topic.
Right.
It's in my inbox when I face it in the morning.
Right.
It's no, this is just in the same way that there's any kind of, I don't know, utility analyst or something like that. And
right.
what generally speaking, these firms do is they have the ESG analyst interviewing the utility analyst and
right.
using out aspects of that industry, which is the Domini approach. We do feel that what's indicative in one industry is less important in another industry. We have very few what I would call universal standards that we look for in every industry. Gender and ethnic diversity are universal standards for us, but whether or not you have well-documented supply chain is less important in some companies than it is in others. So we do look industry by industry.
In your book, you mentioned that you started learning about companies and investing at age 15. What sparked that interest? What would you pass on to other younger people in terms of financial literacy and its importance?
I'm fortunate in that I had a grandfather who didn't kind of recognize age differentials. So he'd always be very alarming. I mean, he would have, some important professor from Columbia to dinner and he'd turn to me and say, well, Amy, what do you think about that? I don't know. But it just, well, no, we're interested, you know, and it kind of pushed me ahead on it. And he did at one point discover I didn't know the difference between a stock and a bond, and was horrified, sat me down and introduced me to annual reports and all of those. And not that I became an expert or fascinated with it immediately on that experience, but it made it not scary anymore. It made it a familiar area of operation and a comfortable area to pursue. And so, yes, always the mentoring, the opening the door, the introducing the concept is an important first step. And as I say, that was one of my purposes in this particular book. I have written more intellectually challenging things than this. This is a series of incidents in my life and how that relates to the ESG investing. And I told in the book about my grandfather sitting me down and opening the annual, he had a stack of annual reports conveniently as a prop in his office. And he opened up an annual report and he said, now here's how you look at these things. He said, the first thing you do is you go to the back. and he looked for the auditor's statement. He said, at the time it was true, it's no longer true. He said, now, you want to see if it's 2 paragraphs. Now, this is a script. If it's any different, if there's any wording that's different from this wording in this report, it's bad news. You don't need to go any farther. And he said, if you see 3 paragraphs, just put the annual report aside and start with a new one. Because that meant the auditor had something to say besides I looked at the books. And they were prepared with general accounting standards.
Right.
So then he said, then you want to get a sense of management and what they think they're doing. So you go to the front and you read this letter. And this is where the CEO lays out the plan for the company. What it's done, yes, but mostly what it's going to do. And you want to read that and you want to see, is this a company that's doing something that's going to make money and work out for everybody? It was so simple and so straightforward that it informed me. It made it possible for me to think of this as a simple field, and it also was a lesson in how to reach people for me. And I have an interest in telling simple stories for that reason.
You mentioned in your book, towards the end of the book, that for you the numbers come last. Can you expand on that for our students and what you mean by that?
Well, you saw first in that example of my grandfather's, those were words. Now the auditor's report had at its point, hey, we don't like the numbers, but those were the words. But what I'm really saying in that statement is you're buying a piece of a company. Is it a company you want to buy a piece of? Is it a company? Is it doing something that you want to be a part of? The vast majority of companies have a fairly similar company doing something along the lines of the company you're interested in. You always are going to have a choice between 2 companies. Which of these is the one that you want to be in partnership with? And that's really what I was getting at with that. The numbers come last. It's a little simplistic. I'm not saying they're least important, but I'm certainly not going to bother to study the numbers if it's not a company I want to be an owner of. And that is, of course, the difference between a stock and a bond. You either are an owner or you're making a loan.
One of the things I've found, and I've been teaching a course on ESG investing for about a year, is just the process of measuring how a
Yeah.
company's rated on an ESG basis and standardized reporting from and across companies.
Right, very challenging.
Perhaps on the social side, maybe even the most challenging.
Yes.
What do you see kind of the state of the art is, and what can be done to improve it, and where do you think the future is going to head there?
Yeah, so important that first we start by counting what can be counted. So, certain information is not available. My approach, and I think it's become fairly much the universal approach, is to start off with attempting to understand what the environmental and social risks are to a company across their stakeholders. So that would be their owners, their suppliers, their employees, the neighborhood in which they operate, the global universe, and we add the ecological system upon which they depend as a component to that. And those stakeholder pieces exist everywhere in the world, but you're talking and probably about the challenge in the US, which is probably the most transparent of the regulatory systems in terms of reporting. And imagine if you happen to be based in Germany. For example, when I started in business, Germany had in their generally accepted accounting principles a line item called bribes. What they had to pay to do business was something, in America, you weren't allowed to bribe. Those are very similar countries in sort of where they start out on people and the planet, and where they start out on what's good and bad business. And even there, you had a very dramatic difference.
Right.
So this challenge is not only a challenge here in the US, it's a challenge globally. But you start with what you can count, and what you can count is a good deal. Now, we, as an example, we can, generally speaking, count. I look for three qualities in what I can count. It needs to be ascertainable. It's publicly available. It needs to be something you can answer with a yes or a no, or with a number. I'm not really interested in your description of how you approach whatever we're asking. And it has to, in some way, inform. It has to be indicative. So, for example, the dollar amount of your corporate charitable giving, nice to have, it doesn't really inform what your company as an operating facility is doing about people on the planet and the stakeholders in the company. So not particularly useful for my purposes.
Right.
Many of those, once you start drilling down, are things that can be counted. You can certainly look at CEO compensation more clearly this year than you could 10 years ago. But even 10 years ago, it was in the proxy statement. Even 10 years ago, you did have information about what the CEO was getting paid, and executives, top 5 executives were being paid. You did have information about benefits for all employees. And so if there was a 401k plan or a retirement plan, it was in the proxy statement. You could pull it out of that. The 10K has for 50 years had worker safety concerns and environmental concerns, potential liabilities for these items as a 10K reported item. So, the reporting may not have been as robust as we would have liked, but it was there. You could pull it out.
Right.
Now, what has happened because of my field is my field has 3 legs, and the research is one of them. Another one is this activism, where we actually engage in the company, and through the activism, we persuaded a great many companies to, for example, disclose their carbon emissions to the Carbon Disclosure Project. That has given us in return a data point. Now we can compare quite well across companies within an industry, trends in data emission. This year, the SEC is mandating disclosure on diversity at the top of corporations, and it's going to put in place some minimum standards in the next year. But that's good. That's information that is illegal to ask, and it's something that, the investment person was kind of stuck looking at a photograph and making a guess. And so it's real and it's coming along. And I don't think these things would have come along. Sustainability reporting is now at virtually every publicly traded company. I mean, it might take it a year or two before it kicks into gear when they go public, but certainly all the top 500 companies and globally it's, heck, I visited a lead smelter in Peru. Not that I was ever going to invest in it. This was a advocacy opportunity. And they had a CSR report. They had a corporate social responsibility. I was, but it is a universal. And so now we're at the stage where these need to be standardized. Well, let's remember the Securities Exchange Commission was created to address exactly that problem 90 years ago. We had a Great Depression, which was in part the result of a crash in the stock market, which was in large part the result of the fact that there were no standards prior to the creation. The CEO stood up and said, "We had a great year." There was no numbers. There was no evidence of that, or they cherry picked them, and a whole infrastructure was created to protect investors. Now we're beginning to see the SEC and Dodd-Frank had a couple of issues, what with the extraction of minerals in politically risky nations and things. We're beginning to see the SEC understand that protecting these same investors needs some new data points. And these data points are beginning to roll out across. And so whether it's voluntary on the corporate side, the way so far the Carbon Disclosure Project has been, or whether it's mandated as the mineral risk disclosure is, you are beginning to see those issues of standardization of reporting come about. It's been, from my perspective, like a rocket ship, but I know it's very slow feeling to people who want more now. The important thing to recall is that each individual analyst or stock picker I keep referring to, but the same is true in venture capital or private, whatever you're investing in, takes data and draws different conclusions. So, we all look at the same earnings per share, and some of us think that's, an indication of one thing, and some of us think it's an indication of something else. And that will be true as these disclosures become more useful. But I know I've gone on a long time. I will say, for some of my peers in this industry, this is also a point of competition where they attempt to recognize ahead of the curve inputs that their competition may not have had. So I was at one of the 5 largest asset managers in America, had a chat about ESG investing, and used as an example their investigation of an opportunity that was a venture capital opportunity that they might doing all the right things for an ESG portfolio to be interested in.
Right.
And the new headquarters had been built in the floodplain. And this Wall Street firm just said, how can you be in that industry and build your headquarters in a floodplain?
Right.
You just can't. That wasn't on anybody's radar even 5 years ago.
Right.
But now it's real money that didn't go in the door, as a result of these kinds of data inputs.
Just to maybe bring our conversation into some current events, when you think about the human tragedy of the conflict in the Ukraine, and then you think about just the economic impact on commodity, specifically energy, but not only energy, but also metals markets. And then you try and think about the progress and to some extent, some momentum towards net zero and addressing climate change. How do you link the two of those? How do you link those? Do you think that it creates kind of a need to deal with different timeframes as we progress and moving towards net zero?
Well, we need a different time frame because the net zero goals are not going to be good for most of humankind. We need to move ahead of those goals. But let me start by backing up and saying historically, the worst situation for an ESG investor has been war. It creates a rise in commodity prices, particularly petroleum prices, areas that are very difficult for an ESG investor. Even before there was a boycott of oil, I couldn't find an oil company to buy. I didn't have any integrated oil companies in my portfolio because they're very dirty industries. They deal with very corrupt people and very corrupt nations, and they kill a lot of their employees every year. There's a high rate of industrial accidents. So these kinds of industries become, they're very dependent on the price of the commodity they sell, and they become very popular during war because commodities make things like weapons and trucks and so forth that we need to fight the wars. And then those things are blown up, so we have to replace them. We can't recycle them or whatever. We have to keep replacing these. Also, weapons themselves are something that I avoid. And this book gives you plenty of anecdotes on the avoidance. I won't take audience time with that concern right now, but you have a situation here. People have said to me for 10 years, oh well, I think the market's about to go down. When I look around and I see, and they point to something, what's going on in politics or whatever, it's about to go down. And I've always said I'm not really focused on what the market's going to do. I'm kind of a full life cycle investor.
Right.
And I'm going to make my bet that over my lifetime, the economy will grow. But what keeps me awake at night over what might happen to the stock market this year? And for the last couple of 3 years, we've had North Korea just out there with the bomb waiting to do something. We've had China circling in on Taiwan, which is humanitarian disaster in waiting. We have had increasing animosity and political nature now within India. It was India-Pakistan thing, the two nuclear powers. And we have had a growing threat from spectacular climate change. I did not have on that list that Russia would invade Ukraine. but that's what happened first. And Russia did invade, and we are seeing commodity prices spike very heavily. The ESG answer is to look at those companies that emphasize garnering materials from recycling operations. There are a good number of them. There are some kinds of commodities and some that are cleaner than others, and they've risen just as commodity world. You don't have to be in the commodity that's sought after once.
Right.
But who knew that wheat or sugar beets or something would become overnight difficult to purchase.
Right.
And of course, our supply chain problems have added to all of that. But you look for the best within the opportunity set, and the opportunity set is much smaller in these difficult to purchase industries. So it is more of a challenge to have a big, I wouldn't even bother to try to have a large cap mining company mutual fund. That's a challenge I don't need to face. But there are solutions, there are companies that go up even in my world, even in this environment.
Right.
I might just stick in my oar on one other thing. We have this bizarre backdrop to it all, where the supply chain issue, nobody thinks has anything to do with America. Maybe we could have built 17 more ports or something that would help us with the landing of the boats and the taking off, but it doesn't help the other end, And so we have had that crush creating rising prices. And then we've had this bizarre COVID where people buy stuff instead of dinner. And that's added to the whole thing. And we've had this war, which is making supplies of certain needed goods and services extremely difficult, and is also putting on economic sanctions that are causing rejiggering supply sources and things around the world extremely difficult. Well, if you can just tell me what exactly the Federal Reserve thinks they're going to accomplish by raising interest rates 7 times next year, I'm at a loss. I mean, what part of this equation am I missing? But it doesn't seem like America really has much to do with any of the underlying causes. And I don't think America can do much to cure them. But that's what's going on in the market now, and that's what's been fooling around. That's what's been leading to these. We're up and everybody's dancing in the streets one day and down
Right.
much the next.
I have more questions. I'm happy to keep going with them, but given the time, I thought, and Sandra and Diana, if I've got this wrong, correct me, please. Should we pass it on to webinar attendee questions?
Thanks, Mark. Yeah, we see one question in the Q&A for Amy. How does your philosophy differ from some of the other philosophies you referenced and have researched?
I'm going to assume that that's my philosophy as regards my field, rather than my philosophy on inflation, what causes it and what makes it go away. There have been approaches that emphasize different things more. So classically, the definition of my field, whether you call it ethical investing, people, planet, profit investing, ESG, whatever you call it, that has had 3 components. Whenever anybody asks me, is that management company real? I say, well, do they do these 3 things? And the 3 things are, do they apply standards to what they purchase, social and ecological standards to what they purchase. The second is, do they engage in moving the needle and getting more information and improving transparency and the most typical world that takes place in is shareholder activism, filing shareholder resolutions, voting your shareholder resolutions. But that's, you know, what got Larry Fink and BlackRock and such big sort of negative news was, you know, you sell yourself on being the ecologist, and yet when it comes time to vote your shareholder resolutions, you vote against the environmental resolution. I think they're changing that in a big hurry. I think they heard that message, but yeah, that was an early complaint. And then the third is community economic development. You need to water the grassroots. You need to bring in those for whom the miracle of capitalism has not yet succeeded. And for many institutional investors, the CDFI or community development financial institutions are a difficult place to go. They're not publicly traded and so forth, but we have green bonds. We have social bonds. We have lots of opportunity in the illiquid risk. And even in a conventional bond portfolio, such as Domini bond portfolio, you can make the investment decisions based on, bonds are wonderful because you're not necessarily buying the city of New York, you're buying the playground that the city of New York is building at this address. You know, that's what they're borrowing money for. So you can really drill down to a very specific purpose, even with conventional opportunities. Now, the question is, where am I different? My emphasis is that all three of these, that it's a three-legged stool and it doesn't, you can't sit on it with one of the legs shorter than another. You need the big commitment to all three. But I do not reject peers in the industry who say, look, I'm a S&P 500 investor and I'm an activist. I'm out there. This is the approach of most church-run money. It's the approach of most union-run money. They go for a conventional investment approach, and then they engage in dialogue with their holdings. And then there's a whole field of people who think you're not doing anything unless you're doing the direct investments. And that's can be venture capital, or it can be the community development end of things. It can be debt or equity. But I consider them all to be fellow travelers because we are all addressing the core issue. And the core issue is that, and I see the questions coming in, so I'll go quickly, but the core issue is, you know, folks, we've got a problem here. The universal goal is a planet that we can live on, that can sustain life and lives worth living. And these two goals have to be accomplished with the tools that we have, and to ignore the largest global tool in our hand. There's no global government, forget that. There's no global charity, there's no nothing. Yeah. But there is a global financial system. So do you or do you not believe that investors need to play a role in saving ourselves? You know, if the answer to that is yes, you're my people, I don't really care what your approach is. That's so, but I see we're piling up some questions, so I can move to these things. And I,
Sandra, I don't have, it's Mark, I don't have the questions in front of me.
oh, well, I do.
You do? Okay, go ahead, go ahead.
In your chat button, if you see a chat button at the bottom of your screen, you may have to touch your bar to see it. The, you know, I guess this ESG, I'll just mention the Wall Street Journal, you know, that I thought it was pretty simplistic. I thought it was very simple, simplistic and very just misleading in the article, as I think I've made the we could have the greatest policies on the planet. I think maybe, Denmark does or something. They're not going to save the world unless we go beyond policy in our own nation. I think we need to have here's the story on finance. I've tried to do the math, and we got some students. Somebody in the audience wants to do this, but you have roughly, I think I saw it was $75 trillion in global GDP, and you have roughly in stock markets, bond markets, option markets, hedge markets, commodity markets, and things that are publicly disclosed. I was able to count in a 20-minute Google search roughly 12 times as much money in finance on an annual basis. So you got this little tennis ball fighting this medicine ball, which one's going to win? Finance is instantaneous, has near perfect information. It's richer than all of the world put together times 12. And a Tesla crashes on a highway, and 14 seconds later, some trader in Malaysia is shorting Tesla, not sure why, but they have the information from the system telling them to short it. How can you not use that as a tool? And the Wall Street Journal story didn't even address that as, just thought it was a simplistic kind of thing. And that, gosh, Andrea, I used to have memorized a website that carried all of these studies, but I can't remember it now. But if you go to our trade organization, US for United States, SIF, Sustainable Investment Forum, ussif.org, there are links there to the articles that they have awarded prizes to. And that's a good couple hundred or so that lead you in that direction. So that's ussif.org. While I'm citing websites, amydomini.com has links to the book, and it's a free PDF if you just want the PDF version. Or if, of course, it's beautiful on a bookshelf, but I did work on it mostly to be an advocate, not that I was anticipating the public would surge to the bookstores for it. We have two that are kind of getting started, one on your own and one on life. And then how do you think about the design against a backdrop of deglobalization? And that's maybe a little larger than the scope of my conversation, but it is fascinating kind of a thought. We've seen very graphically the past week or two presumptions about the fact that it was okay to sell your shoes in Russia. You made the shoes, they're ready, they're sitting on the pallet, ready to be shipped. You've got the customer over there ready to pay the purchase price, and you don't want the reputation for having done business with Russian companies. So as you start to see very stark examples of sort of cutting the ties on globalization, I don't actually know where this is all going to, obviously I don't know, but I could make an argument that actually this war is going to have the opposite effect, or is it opposite, but is going to kind of throw us back into a more Cold War, us and that two big ways of thinking, the totalitarian satisfy most of the people most of the time approach, or the more democratic, feisty, let a few things rip that bother a few people um, approach. And in that world too, we'll be using economics as a weapon. So it's a fascinating, but my own approach is always going to be the same, to look at the stakeholders, people on the planet, and to attempt to make calls on information that I can ascertain and that I can count and that I think is significant. We have two on the next.
Yeah, you've got one about career. I'll just read one. What is the best career advice you've received? And how would you like to the next generation investors to know, and would like the next generation investors to know?
Well, my biggest career break was when I got the job as a stockbroker. I got the job as a stockbroker because I had been a photocopy clerk in the day when people brought their pieces of paper to a certain room, and then 2 hours later, somebody would come by with a wheelie cart and drop your copy off. And as a photocopy clerk, I had been so exceptional that I had risen through the ranks to being the secretary to the secretary of the CEO of the company. And in that glorious position, I had the opportunity to be noticed already at my desk, already having finished my coffee and already having sharpened his pencils by the CEO. And when I went to him in the middle of a terrible stock market crash with the naive idea that all these men were making a lot of money and they weren't doing anything I couldn't do, and said, could I go into sales? Could I become a stockbroker? He knew that I sharpened his pencils well. I did not know, but he knew that Merrill Lynch had just been sued for having no women as stockbrokers.
Oh, wow.
And I got the job for a couple of reasons. One was I was good at sharpening pencils, and two was there was external pressure. I have always felt that those two things continue to be important. You need to build, and we've had a lot of discussion over the last year in corporate management circles about lessons learned on justice and equity in this country. And, one of the big components to all of that, you can say, well, what good is it to 20 people getting their vocabulary straightened out or whatever? But those 20 people and those 20 people and those 20 people and those 20 people build up a standard for what is expected. And during my era, there was a standard for what is expected on gender diversity that was being built. It was a feminist flowering period, and that was also helpful. Now, you can't go out as a career beginner and start a movement that's going to push you into but you can benefit from those things, and you can certainly be good at sharpening pencils. The resumes that we see today are so extraordinary, and the differences are so large that for those of you who have always kind of enjoyed the summer off and not really gotten active in volunteering, I'd say get out there and get something on the resume that makes you a little bit more interesting, because you are competing against somebody who started, an orphanage when they were 7. So it's extraordinary what's out there in the world. And then also, know something about the person you're meeting. do a little bit of the, I interviewed somebody for a partnership position, and she said, just want you to know, I noticed in the Form ADV Part 2 that you and I share the same birthday. Well, it was a pretty effective thing to do. It told me she'd read the Form ADV Part 2, find out who I am, why I'm there. So it was an effective thing to do. Do a little homework. Maybe you can know what's in. You're not going to be invited in to talk a partner role, probably fresh out of business school, but you are being invited in to talk about something important. In terms of this field, it's exploding. There are so many job opportunities. I used to have to say, everybody I know in this industry started their own company. That's just, there are so many ads out there, and so many, I get solicited on LinkedIn all the time.
Right.
Did you guess what my birthday might be? my date of birth might be, year, my age. So there's a lot of opportunity in this field, but you need something extracurricular, not just academics, to say that you're the real thing.
Well, I think, correct me if I'm wrong, Sandra and Diana, I think our time is up, right?
Yeah.
To 1:30?
Yes.
Yes, okay. Well, Amy, thank you for your time. We really appreciate it.
Okay, well, thank
really
you.
enjoyed
It's fun. It's good, and good luck. I mean, I hope you all out there have been convinced to join me in this field. And, if you just want to get a PDF and poke into this thoughts on people, planet, and profit, maybe you'll discover you have more of a passion than you knew you had.
Yeah, I agree. Thank you, and have a good day, everybody.